Catching a major market reversal before the crowd reacts is one of the most profitable setups in trading. You position yourself for significant gains, while everyone else is still trying to figure out what happened. And the most famous shapes for spotting these turns are the double top, which looks like an M, and the double bottom, which resembles a W. But in the highly automated markets of 2026, algorithmic trading systems are specifically programmed to hunt for these obvious, predictable patterns. They intentionally push prices past critical levels to trigger false breakouts and trap retail traders. Simply recognizing an M or W on a chart offers zero advantage. In today's market, it is a psychological trap that leads to capital loss. The first mistake traders make is spotting an M or W shape while the market is simply drifting sideways in a consolidation range. This side-by-side comparison shows the strict prerequisite for these patterns. On the left, an M shape forms inside a flat horizontal channel. That is invalid. On the right, the pattern forms at the absolute peak of a steep, sustained uptrend. A valid reversal pattern cannot exist unless there is a powerful, established trend to reverse. Demanding clear contextual trends filters out the majority of losing setups before a trade is ever even considered. Look at this double top chart. The foundational neckline is drawn across the lowest pullback between peaks. Until price breaches this line, the pattern is theoretical. Entering early is a gamble. You need a decisive, full-bodied close below the neckline, validated by massive volume. Patience for the decisive close, coupled with a volume spike, is the only way to mathematically confirm a shift in market sentiment. After a breakout, you have two strategies. The aggressive entry triggers the exact moment the decisive candle closes, ensuring participation but risking a false breakout. Alternatively, the conservative retest waits for price to loop back, touching the newly formed resistance neckline before bouncing downward. Choosing between the aggressive breakout and the conservative retest dictates your entire mathematical risk profile. To upgrade this pattern to an institutional-grade edge, you use confluence, the practice of layering multiple independent technical signals to validate a single trade idea. This split view shows how the Relative Strength Index, or RSI, acts as a critical lie detector. RSI is a technical indicator that measures the speed and change of price movements to identify overbought or oversold conditions. On the top chart, the price makes a slightly higher second peak. But on the bottom chart, the RSI line makes a drastically lower high. This divergence shows price moving opposite to the indicator, proving momentum is exhausted. Relying on a naked shape is amateurish. Trading a pattern backed by the confluence of momentum divergence is executing a professional edge. Identifying a great entry is useless without a rigid, predefined mathematical framework for exiting the trade. To calculate an objective profit target, we measure the vertical distance from the pattern's peak straight down to the neckline. We then project that distance downward from the breakout point, establishing a highly accurate exit zone. For a conservative entry, your hard stop-loss boundary is positioned just above the specific peak of that neckline retest to protect your capital. Establishing these exact measurement and risk zones before clicking the mouse provides a mechanical framework, reducing the need for split-second emotional decisions during the trade. Compare these two approaches. On the left is the amateur trader, guessing at shapes on a cluttered chart. On the right is the professional, operating systematically with precise entry, stop, and target zones clearly defined. The complete FXNX reversal methodology requires strict neckline confirmation, validation through a volume spike, layered confluence, and mathematically measured risk. Stop donating your capital to algorithmic traps. Apply this professional structural framework today, using FXNX's ultra-fast execution and zero-pip spreads to trade the 2026 market with precision.